Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at energy fuels.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps us keep the lights on and the analysis flowing.
It really does.
Now, let's get right into it. Energy fuels. I feel like every time I open a financial news app or, check the trending tickers, I see this name popping up.
It's everywhere right now.
But looking at the surface, it just seems like a standard mining company. Digs rocks, processes them, sells them. Why is this company catching so much heat?
It is, and for good reason. But you really have to shift your perspective. If you just look at energy fuels as a company with a shovel, you're missing the forest for the trees.
Okay.
The narrative here, and this is really the core thesis, is that this isn't just a mining play. It's a critical infrastructure play for the entire Western world.
Infrastructure. That's a big word. I usually think of bridges, power lines. You're saying a mining company fits that bill?
In this climate, absolutely. They're positioning themselves as the mine-to-metal leader. Think about the global chessboard right now. The U.S. and its allies are desperate to decouple supply chains from China.
Especially for critical minerals.
Exactly. So energy fuels isn't just digging. They're building a supply chain that is completely independent. They're the leading U.S. uranium producer, but they're also moving very aggressively into rare earth elements.
Okay, so it's a sovereignty play. We need this stuff for, nuclear power, for defense, and we don't want to be reliant on a single supplier.
You've got it. It's about security. But here is the kicker, and this is the part that gets buried. They have a massive competitive advantage, a moat. It's called the White Mesa Mill.
I've seen that name. That's their processing facility, right, in Utah?
It is their crown jewel. The White Mesa Mill is the only conventional uranium-vanadium mill permitted and operating in the United States.
Wait, hold on. The only one?
The only one.
In the entire country? That's hard to believe with all the talk about a nuclear renaissance.
It's true. So if you're digging up conventional uranium ore in the U.S. and you want to turn it into something usable, you have to go through them.
So they control the bottleneck.
Completely. Think of it like owning the only oil refinery in a state full of oil wells. Everyone else can drill, but if they can't process it, it's just dirty rock. It protects them from competitors like Cameco or Energy. They have the mines, but Energy Fuels has the mill.
And building another one would take, what, a decade? With permits and everything?
At least. It's an irreplaceable asset in the current environment.
Okay, that's a serious moat. But let's pivot to the numbers. Narratives are great, but they don't pay the bills. I was looking at their financials, and I have to admit, the growth is startling.
It really is. The numbers are finally starting to back up the story.
I mean, look at this. Their last reported quarterly revenue hit $17.71 million. Now, that's small potatoes in the grand scheme of things.
Of course.
But year over year, that's a 337% increase.
It's explosive.
Yeah.
That's what happens when you go from development into actual production.
And they beat consensus estimates by nearly 80%. That's not a small beat. That's a blowout.
It was. And it's important to see where that's coming from. It's not just some accounting trick. It's real physical production ramping up. In 2025, they mined over 1.6 million pounds of uranium.
1.6 million pounds.
From their Pinyon Plain and LaSalle complex mines. But, like we said, mining isn't selling. They produce over 1 million pounds of finished yellowcake, the U308, and the momentum is accelerating. Just in December, they did 350,000 pounds.
So they're actually doing it, not just talking about it?
Right.
But here's my usual skepticism with miners. They're notoriously cash poor. How's their liquidity? Are they about to dilute shareholders to fund all this expansion?
That's the standard fear, and usually you'd be right. But Energy Fuels is in a very different spot. I'd call their balance sheet, well, it's fortress-like.
Fortress-like. High praise for a miner.
But it's accurate. They are effectively debt-free. And on top of that, they've got roughly $300 million in liquidity and working capital.
Wow. $300 million in the bank and no debt. That is extremely rare for this sector.
It is. And that's why they're not paying a dividend right now, which might annoy some people. They're taking that cash and reinvesting it into their own mine expansions, places like Whirlwind and Nichols Ranch. They're funding growth themselves.
That's smart. So the uranium side is locked down. They've got the cash. But you mentioned the shift into rare earths. Is this just a distraction, or is there real meat on the bone?
Oh, it's much more than a distraction. This is the catalyst. They recently announced a massive acquisition of Australian Strategic Materials, or ASM.
I saw that headline. The deal was valued at what, around $300 to $400 million? That's a big bet that's pushing all their chips in.
It is a huge bet, but the goal is just as huge. They want to become the largest non-Chinese mine-to-metal and alloy rare earth producer on the planet.
There's that independence theme again.
Precisely. They're integrating ASM's assets with the White Mesa Mill. They've already upgraded Phase 1 there to produce nearly 1,000 metric tons of NdPr annually.
NdPr, let's break that down. We hear it all the time with EVs.
Right, neodymium praseodymium. It's the muscle in a high-performance magnet. You need it for EV motors, for wind turbines, and very importantly, for defense systems. Missile guidance, jets, you name it.
So critical stuff. You can't build a modern economy or military without it.
You really can't. And their goal for Phase 2 is over 6,000 tons per year. Plus, they're targeting heavy rare earths like dysprosium and terbium, which are even harder to find and essential for high-temperature applications.
So they're building a supply chain for the Pentagon and Detroit at the same time. Okay, I can see why the stock is moving. Speaking of which, let's look at the chart. I pulled it up, and it's a rocket ship.
It's been an incredible run, yeah.
In late 2025, it's trading near 12-year highs, up about 180% year to date. Just recently, it surged over 8% to $26.27.
That kind of move gets everyone's attention.
It does, but it also makes me nervous. When a chart goes vertical, gravity usually kicks in. It's trading, what, 31% above its 20-day moving average and 52% above its 100-day. That's a huge gap.
It's a very stretched rubber band.
Yeah.
That's a fair observation. The momentum is there, the MCD is bullish, but you have to look at the RSI, the Relative Strength Index.
And what's that telling us?
It's at 67.77. So technically that's still neutral, but it is getting very close to that overbought line at 70.
Right.
It suggests momentum is strong, but we could easily see some short-term profit taking. You don't get a 180% gain without some people cashing in.
True. But what's the general vibe, the sentiment? Because sometimes a good story can keep a stock overbought for a long time.
The quantitative data is overwhelmingly positive. Alpha Vantage scores are flashing bullish to strongly bullish. The algorithms love the news flow.
And what's the news flow?
It's all about two things. That ASM acquisition and general support from the Department of Energy for nuclear power. That's a powerful combination.
Okay, what about the human analysts?
Mostly positive. We see buy ratings from firms like B. Riley with a $27 target. H.C. Wainwright is also positive. Roth did raise their target, but they kept a neutral rating.
Why neutral from Roth?
Mostly because of that price run-up we just talked about.
Yeah.
They basically like the company but feel the stock got ahead of itself. They're waiting for a better entry point.
Makes sense. And the big money. Are institutions buying this, or is it just retail?
No, they're moving in. We saw Universal Battalion Guns increase their stake by over 200%. Intact opened a new position, so this isn't just a meme stock.
Okay, but I have to point out the one red flag I saw. Insider selling. About $6.94 million worth. When I see execs selling into a rally, it makes me pause.
That's true, and it's a valid concern. You never love to see it.
Right. Why sell if you think it's going way higher?
But you have to frame it. The institutional buying volume dwarfs that selling. And often, after a stock hits a multi-year high, execs will sell a small portion for, diversification, life events. Doesn't always mean they think the top is in, but it's something to note.
No, not a deal breaker. Fair enough. Any key dates we should be watching?
Two big ones. Late February 2026 for earnings. The market will want to see that production ramp. And then around June 2026, we're expecting the ASM deal to close. That's the official start of the new era for them.
Okay. We've been pretty positive. Let's play devil's advocate, the bear case. What could go wrong here? Because at $26, this is not a cheap stock.
No, you are paying for perfection here, and there are real risks.
First one for me is profitability. So we talked revenue, but earnings per share, they're not there. Consensus estimates are for a loss of about 34 to 35 cents per share this year.
That's the reality of growth phase. They're spending heavily. They are not profitable on an EPS basis, and a classic value investor is going to hate that.
And the valuation, it's trading at nearly 40 times forward sales. 40. The industry average is like 3.7. That's a tech multiple.
It is incredibly rich. You're paying a massive premium for the moat and the growth story. If they stumble even a little bit, that multiple could get crushed very, very quickly.
And then there's just the commodity price itself. The whole thesis depends on uranium staying up around $90 if that price softens.
The thesis weakens a lot. Their margins compress, That valuation looks absurd. And finally, there's just execution risk. This ASM deal is complex. Integrating assets across two countries is not easy. Any delays past June 2026 could hit the stock hard.
So high price, still losing money, and dependent on commodity prices and flawless execution. It's not a risk-free ride.
Not at all. High conviction, high price, that's the trade.
All right, let's bring it all home. We've looked at the moat, the numbers, the catalyst, the chart, and the risks. What's the final verdict? Give me the score.
Taking everything into account. The unique infrastructure, the balance sheet, the geopolitical tailwinds. I'm giving Energy Fuels a bullish score of an 8 or a 9 out of 10.
Wow, that's a very high conviction score, especially with the valuation concerns.
It is. And here's why. I believe Energy Fuels is the premier buy for domestic supply chain security. There just isn't another company that offers this specific combo of uranium and rare earth processing in the U.S. They own the bottleneck.
And they have the cash to weather any storms.
Exactly. Being debt-free is a huge advantage.
So what's the time horizon? Is this a quick trade?
I don't think so. This is a multi-year hold. You're looking into 2026, 2027. You're waiting for the full production ramp on both sides of the business. You want to be holding this when they're actually producing 6,000 tons of NdPr.
So you'd look past the short-term overbought signals?
I'd acknowledge them. The stock could definitely pull back. But for a long-term investor, that pullback is an opportunity, not a reason to panic. The long-term structural shifts support a much higher valuation down the road.
A fascinating setup, a company positioning itself as a guardian of Western resource independence. It's expensive, it's risky, but if they pull it off, they become indispensable.
That's the word, indispensable.
Well, that wraps up our look at Energy Fuels, company trying to power the grid and the defense sector all at once. It makes you think, in a world where supply chains are weaponized, is paying 40 times sales actually expensive, or is it just the cost of insurance? Something to think about. Thanks for joining Smart Wealth with Joshua.
We'll see you in the next analysis.